All right, welcome to The Explainer. Today, we are diving into a really clever investment strategy called tax loss harvesting. It's a powerful way to turn your investment losses into a surprising financial win. So let's see how it actually works.
Okay, let's kick things off with a scenario that is, a pretty good problem to have. Your portfolio has made money. You've sold some things, you've locked in your profits, everything's looking up. But there's always a catch, isn't there?
So imagine you've made some great moves and you've realized a solid $10,000 capital gain. That is fantastic news for your bottom line.
But then, the tax bill comes. And if we assume, say, a 15% long-term capital gains rate, that beautiful $10,000 win suddenly shrinks to $8,500. That's $1,500 you could have kept invested and working for you. So, is there any way to get that money back?
Well, this right here is what we call the classic winner's tax problem. The more successful you are as an investor, the more you potentially owe in taxes. It's kind of the bittersweet side of watching your portfolio grow.
So what's the solution? What if you could use the parts of your portfolio that didn't do so well to solve this little problem? The whole idea really comes down to the time value of money. By pushing off your tax bill, you get to keep more of your cash invested and working for you today.
And that brings us to our main event, harvesting your losses. Let's break down how this powerful technique, often just called TLH, actually works. It's simpler than it sounds.
Okay, the most important thing to get here is that tax loss harvesting isn't about picking winning stocks. Not at all. It's a tax optimization strategy. You are intentionally selling a losing investment to generate a capital loss. You're basically turning a paper loss into a real, usable tax deduction that can cancel out the gains from your winners.
The whole process works in a simple four-step loop. First, you sell an investment that's down. Second, you bank that loss for your taxes. Third, you use that loss to offset a gain somewhere else. And fourth, and this is absolutely critical, you immediately reinvest that money into a similar but not identical asset. That way, you keep your investment plan on track while locking in that sweet tax benefit.
Now, the real magic here is in tax deferral. You're not getting rid of the tax forever, you're just kicking the can down the road. But this is huge, because it means the money you would have paid in taxes gets to stay in your account where it can continue to grow and compound. Over many years, that can make a massive difference to your long-term wealth.
It all sounds pretty great, right? Sell a loser, save on taxes. What's not to love? Well, there is one giant rule you absolutely positively have to follow. It's called the wash sale rule. You see, the government's not dumb. They created the wash sale rule to stop people from trying to game the system. Selling a stock just to claim the loss, and then immediately buying it back like nothing ever happened. If you trigger this rule, sorry, that loss is disallowed for tax purposes.
So the rule creates this 61-day window. You can't buy a substantially identical security within 30 days before you sell or for 30 days after you sell the original one at a loss. In practice, this just means you have to wait at least 31 days to buy that exact same thing back if you want to claim the deduction.
So what in the world does substantially identical mean? That's the key phrase here. Selling, say, Vanguard's S&P 500 ETF and buying it right back, that's a clear violation. But selling Vanguard's S&P 500 ETF and then buying iShares S&P 500 ETF, well, that's generally allowed. Why? Because even though they track the same index, they're run by different companies and are technically different products. This is how you stay invested in the market without breaking the rule.
Now I know what you're thinking. This sounds complicated, like a lot of work. And for a long time, it really was. It was this manual chore you might do once a year in December. But like so many things, technology has completely changed the game.
Today, you've got these sophisticated algorithms and robo-advisors that can put this entire strategy on autopilot. They can literally monitor your portfolio every single day, automatically finding opportunities to harvest losses and managing all the complex stuff, like the wash sale windows and finding replacement assets, all in the background.
And this automation is especially powerful with a strategy called direct indexing. Think about it like this. Instead of buying one big index fund that holds 500 stocks, you own tiny little pieces of all 500 stocks individually. This means that even if the overall index is up for the year, some of those individual stocks are going to be down. Direct indexing lets technology automatically sell just those individual losers to harvest tax losses. It makes the whole thing way more efficient.
So, after all that, what's this effort actually worth? Well, the benefit is often called tax alpha.
It's basically extra return you get just from smart tax management, not from picking better investments. Research suggests that doing this systematically can add an extra 0.5% to 2% to your portfolio's return each year. That is a pretty significant boost.
But hold on. Before you dive in and start selling, it's really crucial to understand the whole picture. Tax loss harvesting is a seriously powerful tool, but it's not a free lunch. It does have its own complexities and trade-offs.
So here's a quick summary. On the plus side, you defer taxes, which boosts compounding. And you can even use these losses to offset up to $3,000 of your ordinary income each year, which is great. But on the con side, remember, the tax is just deferred. It's not gone forever. There's also a risk your replacement fund doesn't perform quite as well as the original one, and it definitely adds complexity and paperwork to your tax filings.
And one final super important point, this entire strategy is only for your standard taxable brokerage accounts. It provides zero benefit inside tax-advantaged retirement accounts like a 401k or an IRA because there are no capital gains taxes to worry about in those accounts in the first place. Ultimately, what tax loss harvesting does is reframe how we look at market volatility. It suggests that maybe those market downturns, as painful as they feel, aren't just a risk to be survived. Maybe they're also an opportunity to make your portfolio more tax efficient for years to come. And that's a powerful shift in perspective for any serious investor.